Hi, today's topic is the mystery of business, according to the High Court of Australia. In a recent decision of the High Court, it was found that certain approaches to goodwill and its measurability were brought into question, and it reaffirmed the findings of earlier court decisions on goodwill as being appropriate. Furthermore, the decision has now defined legal goodwill as distinct from accounting goodwill. The mystery of business is the intangible assets that are created or exist within an enterprise and how they are measured or valued. The courts now say they are right and you cannot ignore them. The accounting industry still believe they are right, and markets continue to recognise and buy and sell goodwill every day. And business structures such as internet businesses create cash flows regardless of what people think. So where to from here? The law has trouble with it, and the accounting industry is in conflict with what the law decides it is, and the markets persist regardless. It's amazing. The law can tell you what it is not, but they cannot tell you what it is. Now, the case in question, that is the Commissioner of State Revenue versus Placer-Dome, Inc., in the High Court of Australia, number 59 of 2018. In October 2005, Barrick Gold Corporation, Inc. made an offer to acquire all of Placer's common shares. On the 4th of February 2006, Barrick Gold was successful in its takeover of Placer for $15.3 billion. In its consolidated financial statements, Barrick adopted conventional accounting practice of allocating to the tangible assets as fair value and allocated the residual balance of the purchase price to goodwill, namely $6.5 billion. And that was their intangibles. The High Court had to decide between the tangible assets and the intangible assets and whether the tangible assets were more than 60% of the total value. This is where there is a massive problem with using balance sheets or top-down or bottom-up approaches, namely residual balance methods. The only time goodwill is represented in the balance is, or in the balance sheet, is if it's purchased goodwill, not internally created. Whatever happened to current market values? This High Court reaffirmed Spencer's case, which deals with market values. Balance sheets record the historic price paid for property, buildings and plant and equipment, which is then reduced via accumulated depreciation. Current market values will always disagree with balance sheet values or written down values of plant and equipment. Accounting and taxation concepts have nothing to do with markets and should be ignored. The High Court rejected the use of discounted cash flows in mining operations and cited uncertainty and unreliability. I believe that discounted cash flows in business valuations should never be used, and I state that if you cannot value the components of a business today, you will never improve your valuation by trying to predict the future. Business income is far too volatile to ever simulate market movements or conditions. You should only use numbers you can prove. So let's look at the cases that this High Court judgment reaffirmed in determining what goodwill is. The law was on the right track at the turn of last century. In the English case Inland Revenue Commissioner versus Muller, 1901, Lord Macnaghten introduced the notion of goodwill must emanate from a source, which I describe as market transactions, and described it as being the attractive force which brings in custom, which I interpret as sales based on the opposite. The unattractive force would mean no custom or no sales. This case was cited in the Australian High Court decision with support. The hardest thing to do is create turnover. You can have the best assets in the world, but if you can't make money using them, it simply means no sales, no goodwill. In the Australian case, the Commission of Taxation versus Williamson, 1943, Mr. Justice Rich introduced the concept of goodwill as either being personal or locational or partly one and partly the other, and then referred to the Whitman Smith Motor Company case versus Chaplin of 1934, which refers to the dog, cat and rat principle, which classifies customers as different types. Clearly, it does not matter what customers do. Business either attracts customers or it does not. Business comes first, and many businesses can move location without any effect on turnover whatsoever. It is time to move from old concepts and include all transient business structures such as those that are internet-based. Now, the Commissioner of Taxation versus Murry in 1998. This is the only other recent High Court or court decision on goodwill, where the majority of judges found that selling off a taxi plate or licence did not involve selling goodwill. Legal goodwill has three different aspects: property, sources and value, and source was reconfirmed. This concept and belief that assets cannot be separated, which is held by the accounting community, is pure nonsense. If a machine breaks down or wears out, you dump it and you get another. Same with vehicles. Stock is bought and sold and replaced every day. Goodwill can stand alone, as is the case with agency and brokerage businesses such as insurance brokers, real estate, finance brokers, hotel brokers, etc. Now, the High Court reaffirmed the principles of Spencer's case, 1907. Valuing of assets should be based on current market activity with appropriate knowledge or awareness. This rejects counting concepts because of their historic nature and the belief that cost equals value. According to the High Court in Place's case, they rejected discounted cash flows in mining-related operations due to its unreliability and should be ignored for all business valuation purposes. If you cannot value a business today or its components, you will never improve your valuation by trying to predict the future. The High Court reaffirmed the findings in Muller's case, 1901, where goodwill must emanate from a source, and described it as being the attractive force which brings in custom. My methodology supports source, it supports attractive force, and it supports market activity. In fact, it's the only one I suggest you use, and that is based on Spencer's case. Following this recent Australian High Court decision, which confirms my methodology, and in the pursuit of high accuracy, I now change my terminology from sales to completed sales, which casts massive doubt on the use of accrual accounting in the assessment and valuation of goodwill. Sales can be defined as income, revenue, turnover, cash flow, or earnings. So let's look at what the accounting industry thinks goodwill is. And this is taken straight from their standards. According to the Australian Accounting Standards, AASB 1013, goodwill is the future benefits from unidentifiable assets. According to this, the accounting industry cannot identify what goodwill is. They claim it is unidentifiable. They do not know what the future benefits are, nor do they know how to identify goodwill. When you do not know what creates goodwill, or there is no consensus whatsoever on what it is, how can you claim to understand it or value it? This High Court decision has recognised that legal goodwill is distinct from accounting goodwill, and certain methods cannot identify asset classes with clarity, nor can they measure goodwill with accuracy or reliability. The only goodwill that shows up in a balance sheet is purchase goodwill, and even then, it is recorded in error because they accept written down values rather than current market values at the time of the transaction. If markets can accept sales as the source that generates the intangible asset of goodwill, then it is possible to track sales, quantify them with margins and directions, and ultimately value them in real time. Other accounting methods fall well short of clear interpretation because they use suspect, lower, unreliable numbers and compound their methods with unrealistic predictions about the future. Well, I want to show that it is possible to value and track goodwill. If sales are increasing, declining or static, you can value every movement in the market. Profiling and benchmarking and the assessment of management are all possible and in a graphic format, and it is all provable. Sales are the only provable number that indicates and confirms that transactions have occurred and with what margins. If margins diminish, so does value. If you rely on the most provable number, you can prove source, attractive force, personal or locational. Now, people buy and sell goodwill every day of the week. And in fact, financial analysts have now adopted a methodology of applying multiples to earnings, very similar to mine, or sales, and they create very high numbers such as multiples of 10, 12, 15 or 18, thus no longer linked to net profits, EBITs or EBITDAs. However, these multiples are absurd. They are not backed by market activity whatsoever, yet they claim so. So let's look at an example. Assume that a business has sales of 10 million and makes 20% net profit, which is equal to 2 million. We'll consider this equation using the analyst method. If there was turnover of 10 million, they'd simply times it by a high number of 15, which equates to 150 million. That means that with 2 million net profit, it would take 75 years to get your money back, provided turnover stays the same, net profit stays the same, and management and staff stay the same. The chances of that is none and Buckley's. You should never buy an asset if you never get your money back. That is the domain of fools. It is my hope to contribute to financial and legal industries in the future, and that there is a methodology that can identify goodwill and measure it reliably and is backed by the courts. Therefore, the mystery is solved. That concludes today's presentation. I hope you get your copy of my book soon. Thanks for watching.